Start again.
All right. Hey, everybody. Thank you for bearing with us with some technical difficulties. I'm not saying Hicks is getting fired, but I'm not saying it. It is July 30th, 2026. We've got a lot to get to, economic data flowing through as we speak, but we are going to open with the Federal Reserve yesterday, Tom. Kevin Warsh communicating in a way that I felt like maybe people in our office understood and found helpful, but not a single austere journalist in the whole room could even begin to fathom what he was talking about.
Yeah, it was really interesting. Going back all the way to the beginning of my career, I can't say that I've seen a press conference where there was more of a high-level discussion of what the Fed was actually doing rather than just
reading data.
Yeah, reading data and sort of basically the Fed chief speaking off the top of their head about what the questions were. This is really Kevin Warsh, rather than giving forward guidance, is really being aggressive at saying, here's what we're looking at, here's why we're doing the things we're doing, and here's what I think the reaction is. And I think maybe the biggest piece that he said is that people are no longer, they're playing the ball and not playing the ref. And I think that's what you're seeing in the markets. And he explained, he doesn't really have to raise rates because the market is now looking around and saying, hey, what is the market reading from the data? What is the market reading from economic growth? And rates are adjusting themselves. And
the media could not handle that.
They couldn't handle it.
They did not like that he recognized that the market was reacting and implying one thing and that he wasn't doing that same thing.
Yeah, and it's like rates are significantly higher now. And the real read of how restrictive rates are positive real rates. Well, we've hit new levels of positive real rates, which means that the bond market has taken the stance naturally through buyers and sellers participating in the market of throttling inflation by increasing rates.
Inflation break-evens implied by the market. So even though rates have gone up since Warsh was confirmed on May 22nd, the inflation break-even on the 2-year, what the market thinks inflation is going to do over the next 2 years, has fallen from 2.75% to 2.15%. I think it's up down to like maybe 2.25%. But it's come down dramatically simply by playing the ball, not the ref. The markets have readjusted inflation expectations downward to the tune of 50 basis points in the space of 2 months, something that wasn't done at all in the last 63 months under the previous regime.
And what's interesting too is that there's a lot of hemming and hawing about what the overnight Federal Reserve rate should be, but almost nothing trades on that.
Nothing.
And so what's changed is the 2-year Treasury has come up a lot. The 10-year Treasury has come up a medium amount, and the 30-year Treasury has come up the least amount of those three. And as a result, where those things are pegged and the borrowing rates that are attached to those have all gone up quite a bit. And so that's the big change, is that now we've got a situation where we're in a very restrictive rate environment without the Federal Reserve being restrictive at all. And it doesn't really matter because nothing really trades on that overnight rate anyway. There were some dissenters. It was 9-3 vote, not even a big deal. And they're pretty much along the lines of what we thought would be the dissenting vote. But really, it doesn't matter what the Fed does with the overnight rate if the market is now allowed to do what it is supposed to do. And I think, honestly, rates are up again today. And I think a function of that is that the spin zone that came out of this was Kevin Warsh has no credibility because he didn't raise rates. And all of the questioning in that press conference was, okay, well, if rates are higher, how come you didn't raise your rate? And basically the answer is he doesn't have to. They've raised themselves. And he tried a number of different ways of attacking that. But what's interesting to me is if he has no credibility for not raising interest rates, how come the narrative is also not Jay Powell had no credibility for cutting rates? Yeah. Because he cut rates when the jobs market was worse, when the inflation level was worse than it is right now. I mean, at least based on the last reading. How come he had absolutely no credibility for doing that, particularly heading into an election cycle? I mean, you can't have both. But Jay Powell never sat down and was like, here's what we're really working on. Here's what the inner workings of the Fed are. Here's the 5 questions we're mulling in our heads right now. And the idea that inflation was systemic under Jay Powell because of massive money printing and demand stimulus. So the Biden administration and the Federal Reserve at that time was juicing demand to levels of insane levels that basically pushed inflation up. So Biden's cutting checks to give to people who are then buying goods that are primarily coming from outside of the U.S. It's not creating any economic value in the U.S. It's creating a lot of economic value elsewhere. And not only that, but we're printing that money to create those purchases, which just does nothing but blow up the M2 money supply and puts demand way over supply. Well, what's going on now is we've got extremely restrictive rates. We've got tariffs in place. We've got a lot of money that's flowing to the production of goods and services within the United States. And so what you're seeing is...
And no new money.
Rather than generating new demand, what we're doing is we're reducing demand by having rates increase, and we're increasing supply by generating those goods and services and that GDP inside of our borders. And that's, we've talked a lot about the difference between, Keynesian economics and the Mises Austrian School of Economics. This is Austrian all day long, and people are either unfamiliar or uncomfortable with that. But that's not the way the business has been done in the U.S. for the last 50 years. And there's going to be some growing pains, but the result is going to be we're going to create new goods and services, buildings, data centers, economic value within these borders, which is going to enrich the people who work here, which is going to give us cheaper goods at higher supply levels that we've had. And then we're also going to have economic growth and prosperity where you're making money in your pocket to buy those goods. And ultimately, we're going to settle at a level of lower inflation rather than just we're going to print money. We're going to hand out checks to anyone and everyone, whether they're from here or not. And as a result, create no value. And so if you increase demand, create no goods, create no value, what you get is inflation, especially when you're printing that money. The opposite is true now. And it's going to be a bit of getting used to, but the net result is going to be insanely positive economically. And that would necessitate higher long-term rates. And that's fine because if houses are expensive because the rates are higher, well, people are going to be making more money. And that ultimately offsets it because wage growth in real terms has been flat for decades. And this could actually create real wage growth, real actual wage growth, kind of like real rates. You're getting real wage growth as opposed to nominal wage growth.
And he talked about the supply issue specifically as he talked about, the CapEx spend from these hyperscalers and the data centers coming. And he used real examples of what Tom just laid out actually coming to fruition as he talked about it, accelerating supply and the impact that will ultimately have on pricing. Notably, he is, if nothing else, 2 press conferences in on this guy. He's not going to let the Fed act for the sake of acting. And he's not going to be driven by the odds or the narrative from the media on what should happen.
And the narrative, too, is like the only way to show that he's independent is to do the opposite of what Trump is asking for. But there are 3 options. Not cutting rates is just as independent as not hiking rates, is just not as independent as cutting or hiking them. I mean, if you do the opposite of what someone says to show how independent you are, you're not really doing anything.
You're stupid.
Yeah, if you tell your kid to pick up their toys and they say no, that's not independence.
Yeah, you're not like, wow, what a hero.
Yeah.
That's just contrarianism.
Yeah,
which is itself dependent.
Yeah,
I've got to know what you're doing so I can know I do the opposite.
Yeah, but it's like I'm going to pick up one toy. It's like, well, you've accomplished what someone is asking to a certain degree, but you've also, not been obstinate for the sake of doing that. And that's really, I don't understand this narrative. I mean, all day long they were just like, man, he just destroyed his credibility. I couldn't tell you a time where I felt more locked in on the Fed in terms of how credible they're being based on the narrative that Kevin Warsh was displaying yesterday.
A great one-liner, and then I want to get your thoughts, Ben, but he talked about, somebody asked about the data. He said the problem with data dependency is the data and the dependency, which is thematically a lot of what we have talked about on this call for the last 6 years.
Yeah, I mean, just 3 quick points from me. number one is my big two takeaways from Warsh are two things that I think everyone in the media kind of missed because they were so focused on why didn't he raise rates. The first one being exactly what you said. There is a supply response, and he kind of showed his hand when he said, you know what, we'll have to see. Supply is accelerating. We'll have to see what happens to prices there. I think he showed his hand in terms of that's what he believes is going to happen. And I think he's right about that. I don't think he's going to have to raise rates because I think inflation will come down because of the supply response. The second piece is beginning in January, they have a task force looking at the data, and he's going to be looking at other forms of inflation, presumably ones that use real examples of home sales and home prices to inform him on what's going on with inflation. And so I think that you'll actually have a resetting of inflation significantly lower next year that, again, will allow him not to raise rates and maybe even cut. And I contend that that's the case. That's what he believes. The question is whether you not believe you agree with him or not, and I do.
Yeah,
like, frankly. And then the last piece is higher real rates and a steepening yield curve imply that the market thinks growth is accelerating. This is always done when you have higher real rates. It means higher prospective returns in the market, in the economy, and higher GDP, which is good for everyone, including us who manage money and including you who invest money.
Yeah. I mean, it's never been a better time in history, at least in my investing lifetime, to be a person who is about to retire or in active retirement, because the amount of yield you can get on your bond portfolio is so much more.
And
all the way back 2007.
And what the rates imply about future equity returns, I think, is very interesting as well. And that's something we haven't talked a lot about, but I think it's something we're going to have to consider going forward.
And maybe one last point is, and Ben, you brought this up this morning when we were kind of pre-call chatting. What does raising rates do to oil prices or memory chip prices? Nothing. Kevin Warsh knows that. And I think that anyone in that room in the press corps would also know that. But they're unwilling to understand that, like, the things that are driving inflation the most right now have nothing to do with
the overnight.
I was talking to Tom about this. I think I'm going to do a blog post called The Gentrification of Memory Chips. And essentially what it's going to be is you have like 75, 285 interchange. You might have had a garden shop there, 10 years ago. Well, Truist Park comes in. That's no longer the highest and best use of that property. You can sell that piece of property for a much higher price by building a high-rise hotel.
Yep.
And that's what they did. And the property prices went up, and that wasn't a bad thing. The beautiful thing about memory chips is we can make more. You can't make more land. And so I think that's going to be very interesting to see.
PCE came in down 0.1% month over month, in line with expectation. Core up 0.1% month over month. The expectation was 0.2, so getting a core reading at 3.3 over the last year. Bank of England keeping rates locked at 3.75. We got a lot to get to, but we did get a Russian missile landing in Poland, and Trump is heating up the war. Supposedly planning a 10 to 14 day aggressive campaign. We'll see what happens there. And South Korea is banning short selling to try to curb market volatility. We've talked about their market and its concentration in just a handful of companies ad nauseum on this call, but we'll see how that goes.
Probably should have done it a couple months ago.
Yeah.
Let's jump to earnings, Ben. We've got Meta down close to 10%. We got Microsoft up close to 10%. What are your takeaways as you think of these big tech companies?
Biggest takeaway is time to value. There's a couple concepts in finance as to measure returns on investment. One is you compute the actual projected return on investment. You do discount rate. The other one is just use a payback period, which is essentially I make an investment and in 2 years I get my money back. It's the Kevin O'Leary style of investing. And right now that's what the market's doing with a lot of this CapEx. The thing with Microsoft is when they put chips into the cloud, they can immediately start making money on that by renting those chips out. And so their time to value is faster. Meta is using those chips to build its own internal models and improve the advertising business, which is going to improve revenue over time. In fact, they actually have some really interesting business use cases. They obviously have the massive WhatsApp, Instagram, and Facebook properties. They're going to have a bunch of millions of agents talking to people and getting their views on things, which is going to provide this proprietary insight to advertisers to optimize their advertising. And I think that's going to be incredibly valuable. They're going to be monetizing APIs. So Meta has some other businesses. They're thinking really big about this. And I think that that's going to pay off in a massive way. The other thing is they're front loading CapEx in order to fund that, which means higher costs in the short term, lower revenue in the short term. Market doesn't like that. But I think that 2028 comes around, those costs are going down, revenue is going up. I think you're going to like owning Meta stock for that for the long term. Microsoft, they really did a great job. And this is what we're talking about with creative destruction and you know, it's like the Jurassic Park quote, life finds a way. Business, especially really good businesses, find a way. And Microsoft's finding a way around high memory prices, high chip prices, high GPU prices, and high energy prices. What they're doing is they're optimizing their models so they can now get more output, more tokens per GPU, per CPU, per watt of energy, which is A, increasing revenue, and B, lowering costs, and market loves that. Stock's up 10%.
On the restaurant front, two places I distinctly dislike as a consumer: Starbucks and Chipotle, both up more than 5%.
Starbucks really kind of getting its feet under him. Again, I mean, they're growing same-store sales. I mean, for the longest time, they couldn't grow same-store sales at all in North America, and now they're growing by 8%, both in transactions and ticket. But here's the important point. Ticket is being driven by upselling or attaching food to it. It's not being driven by pricing, which is up less than 1%. Opposite for Chipotle. Chipotle had an extremely low bar ever since Brian Niccol jump ship from Chipotle to Starbucks. Chipotle has been really not in a good spot. They had comps of just 2%, but that was better than expectation of 1%. And pretty much all of that was pricing. So Chipotle not in a great spot, even though they're up pre-market. It'll be interesting to see how these trade once the markets do open.
We've got a number of other stocks that reported. Obviously, those take a lot of the oxygen out of the room. But Ben, curious your thoughts as we kind of build our mosaic as clients are looking at portfolios. We've got companies like Qualcomm that are getting beat up a little bit, but other holdings that are up, kind of 1% may not even show up on your holdings list if you're sorting by biggest movers for the day or for the week. Take us on a little tour of how other companies are performing, what they're saying, what you like, what you don't like.
Yeah, these are not core names for us. Your portfolio may not have them. It might not fit your exact risk profile, but these are companies that we follow and that are in our universe and that are appropriate for some clients. Qualcomm has these big 2030 goals out there for these new AI chips. They haven't built them yet. So it's very speculative, and the market kind of comes and goes whether or not they believe them. And right now, it's going because their Android business is not doing so well on their smartphones. Memory prices are high; people are buying fewer Android phones. Then we've got building materials provider UFPI. They actually perform very well. First time they've got volume growth for years. So good news for them. Construction demand continues to be weak on the residential side. We're seeing the same thing at CRH, which competes with Vulcan. You probably have one of CRH, Vulcan, or Amrise in your portfolio. This is kind of your North America infrastructure play. Q2 was somewhat soft. You had some weather impacts. You had residential construction that was relatively weak. So those stocks may not have done so well for you. But again, this is our long-term MOTI. So they have this big moat around their businesses, plays on North America infrastructure. So Vulcan, Amrise, CRH, all in that. group. Scion, the LTL side, is a local business. Johns Creek. They're getting a lot of growth now. Things are starting to come over from the trucking side. Same with Canadian Pacific, and the railroad up there in Canada that connects Canada, Mexico, the U.S. Again, a play on reshoring into the United States, moving product among North American countries. The one that's very interesting this morning is ICE. They've been kind of at the connecting point of, so they own exchanges, New York Stock Exchange among others. And the hit on them is that once this agents start getting involved, can the agents just trade among themselves off the exchange? So you have a marketplace and then you're doing side room deals essentially. And so that's the concern with ICE, and the stock fell dramatically, but it's since come back quite a bit. They didn't really show any signs of that this quarter. Going forward, what I would anticipate is that they continue to be fairly resilient. But what the interesting piece of news for ICE this morning is that they're making a very shrewd deal. This company was founded with $800 acquisition by Jeff Sprecher, the husband of Kelly Loeffler, in the late 90s. And he's grown by very shrewd acquisitions over the last 25 years, and he's continuing to do it. Today, they announced the acquisition for $6 billion of market access at a 33% premium. You might say, why on earth would you buy another company at a 33% premium in this market where there's a bear case about agentic commerce? Well, here's why. Even at the 33% premium, the deal price is $167, all cash, and the stock traded at $190 as recently as March. This is basically a take under of the business. They're buying it at 10 times EBITDA. This is genius, I think, from Sprecher. I think it's genius from ICE, and I think they're going to reap the benefits of it, Tom.
Yeah, this is a massive consolidation in the fixed income space.
Yep.
So Market Access is basically the largest ETN, electronic trading network for corporate fixed income. We used to try and get on their platform. You've got to be moving a lot of money to get on Market Access. But what people don't know probably is that the largest ETN that for municipal bonds was purchased by ICE a few years ago, which is something called the Muni Center. So that's two out of the three big ones. The third one is TradeWeb, which is sort of a hybrid of the two, and is far less advanced technologically. At least when I left the desk, TradeWeb is sort of a goofy DOS-looking version of Muni Center or Market Access. But they've also consolidated the pricing in the bond world. So even if you don't own the exchanges, you own the pricing. So it used to be there were a number of different pricing services. So you had the IDC price, you had the Schwab price, and you had what they call BVAL, which is Bloomberg pricing. And depending on who or where you were placing those bonds, the price could be wildly different. Well, so quietly, ICE bought up all of those and consolidated in what they call ICE eval now. And BVAL, which is the Bloomberg one, just died on the vine. Has absolutely no bearing on anything.
They were so bad anyway.
Yeah, you'd think they would be able to dominate that, and they should have been able to, but they didn't. So ICE now has cornered the market on corporates, munis, and the pricing of both. And all that feeds into every custodian now. So the price is the same at Schwab, at TD. Well, I guess those are the same now too. But Fidelity or LPL, all that pricing, you have to pay a fee to ICE just to have the bonds priced correctly in your accounts. And so really shrewd, because I mean, back in the day when I was constantly applying for jobs at ICE trying to get out of Starbucks, they basically had cornered the market on like coffee futures. It was a very small operation that had some really niche areas where they dominated, but it wasn't what it is now. I mean, now it's just a massive, massive conglomeration. I mean, they own the New York Stock Exchange and the two largest bond markets, at least electronic bond markets in the world now, assuming this deal goes through.
Yeah. And it seems like it would. It doesn't seem like this would be something that necessarily would have regulatory pushback. We'll wrap it up here.
Also, Sprecher's a big Trump guy.
Yeah, exactly. Yeah. Number of companies moving bigly this morning. Some up 8, some up 5, some down 10, all over the place. I do want to read this, and you guys obviously have the notes, so I'll give a little pause for the live viewers and the listeners to think rhetorically about this. But this is from Adidas CEO. Being the CEO of Adidas is a privilege. Being the CEO of Adidas during a World Cup is even better. The World Cup was like a fairy tale for me. I'm so proud of what our teams around the world achieved. I do not think we could have scripted it better. Hearing that, how do you think the stock's doing? It's down 18%.
They're still better than Nike, though.
Couldn't have scripted it better.
A lot of people are saying our sweet princess, Sophie Cunningham, her shoes have already sold out, though.
Yeah.
So
got to get her on the pod.
She's out there, yeah.
Yeah.
Fighting the good fight in the streets.
Yeah.
Against LeBron James and the woke masses. So it's trending on Twitter this morning.
Yeah.
So
yeah, Adidas down 18% thanks to the dreamlike script of the World Cup. So we'll wrap it up there. We'll be back tomorrow. Y'all have a great day. Talk to you soon.